I've got a couple online, so that's great. And it's 10 o'clock, so let's get started. Thank you, James, for joining us this morning. And welcome everybody on the call. The purpose of this call really is just to help get a bit of an understanding of what's happening in the market, what's the impact on your investments with KiwiSaver, and where things could be heading, and is it time to panic or not, and what's going to be the best outcome for the future. So just a quick background, I have worked with NZFunds since 2003, and we were introduced to NZFunds when Sid Singh was on the road and Anna was running around. So they have been a company we've worked with. They've survived the global financial crisis. It was a critical time, 2008, 2009, when there were significant drops in the market. We spent time with the directors up in Auckland and got a better understanding of what was happening inside the markets. From my perspective, that's a critical time in terms of maintaining an ongoing relationship with NZFunds. And so we've managed that right through to 2020. So 17 years worth of relationship partnership. And James, I've just met recently in the last couple of years as the new Chief Investment Officer. A bit of background on James that I've learned. He's actually got a background as an officer in the Army for 3 hierarchy territorials, so we connected on that level. But he began his career at NZFunds in 2000 as an intern and became an equity analyst in 2004. He spent some time in the Middle East in 2009 with New Zealand Defence and relocated to London, where he worked in management consultancy and private equity. James came back to New Zealand in 2015, following a senior role at Macquarie Bank, and then came back to NZFunds in 2017. So that's a bit of background on James. He's a CFA as well, and I've enjoyed listening to his talks and presentations the various times I've been up to Auckland, the NZFunds. So we'll just hand over to you, James. Just interested to hear your thoughts. I noticed that yesterday was the strongest growth day since 1933 in the share markets. You've got some thoughts or comments on that?
Yeah, thanks, Robbie. Thanks, really appreciate you having me online. I think it's, for me, this is a real highlight of what I do, is being able to actually talk with clients around their experiences investing with NZFunds. And I think now is probably an opportune time for any of you who want to ask questions or think about our investment philosophy or approach. Hopefully it's a good time to do that. On your personal circumstances around, should I have more growth assets? Should I have less growth assets? Those sorts of things. Robbie's your man on those questions, and that's his absolute specialty. And those different specialties combine to provide you with what we think, Robbie and I together, the best sort of portfolio. And so, but more than happy to take questions around, anything, and I'll happily defer to Robbie if I think it's more of a Robbie question. But look, yeah, Robbie, I think yesterday, or the night before, to be honest, I'm not sure how you're all feeling at the moment, but it feels like every day is sort of rolled into one. I sort of forgot it was Thursday today. I felt like it was Tuesday. It's been a really interesting week, and I think first and foremost, I hope everybody's doing okay. And on the first, 12 hours or so of lockdown, and everybody's families are okay. It is a stressful time medically and for socially, in terms of being worried about family and friends. But on the investment side, I think things are happening, albeit with a lot of volatility. They're happening in ways that we would probably expect, and that's why we've been able to be relatively prepared for what's happened, despite not knowing that COVID-19 would be the cause of the volatility. Nonetheless, we've managed to be prepared for it, because in markets these things do happen. And so I guess if we think about the why specifically, to answer Robbie's question, did markets go up quite significantly the night before last, and had another positive night last night in the US? So that's 2 in a row, which is, in the scheme of what's happening, has been a rarity. It really does go to what governments are doing to really support the economy. And I'll give you a really good example. I actually heard this heard this sort of scenario set out on national radio this morning, and I think it was a really interesting point. The Marshall Plan, when basically the US bailed out Europe, was in today's dollars $130 billion. And that was considered an absolute huge sum of money in the context of bailout packages and measures and government intervention. And that's $130 billion in today's dollars. The stimulus package that the US government just announced is $2 trillion. That is just absolutely massive. Now, it doesn't necessarily mean that government bailouts and support for the citizens of their countries, if you put it into the context of it, just because the government's going to send you in the US a check for $2,000 each family member, you're not going to pick up and go to the movie cinema and watch a film because there's still coronavirus around and the worry about infection rates, etc. But it does show the extent to what governments are prepared to do to support the economy. And when the medical event that we're going through does come to an end, and there's a number of which ways that could happen, whether it's a vaccine or whether, perhaps what we're trying to avoid in New Zealand, a scenario where most people get it and then get sick, and then people recover and move on with a cataclysmic effect on the older population. But one way or another, these things do get contained in some ways. When you've got a stimulus package like they've just announced that is going to have huge benefits to share markets, it will just be a volatile journey to get there. I'm not suggesting that it's all over now that the market's up. We're certainly going to have some big down days again. But overall, I think the trajectory is going to be a bit more contained because of what governments have been able to do. And it sounds, I think, I'll just say one, it sounds really inappropriate in some ways to talk about markets going up when we're going through medical events. And I think it is right to feel somewhat uneasy about those comments. But I think how we are thinking about it is, if I put my situation example, my brother lives in New York and he's got coronavirus, as his wife does, and his 5-year-old. And they're in good spirits, but it's not very nice. They're lucky, they're in their 40s, and so they should recover and should be okay. But he, once he does get through that initial hardship, he still has to think about his retirement savings. And I think it's really important that we all always keep in mind that we have to be optimistic. We have to think over the long term still, and we have to make sure that we're sort of making sure we're always thinking about what the future holds and what we can do to better prepare ourselves. And so that's how we're thinking about it.
Thank you, James. I mean, certainly we learned that through the GFC 12 years ago. It seemed like the end for many people, and 50% drops in values. And I know in Asia, because I was in Hong Kong at the time, people were jumping out of buildings rather than facing their family or their employers because of the debt they'd got themselves in. So, regardless of what happens, it's never that bad. We live in a country where there's fresh air and there's food, and we're blessed. One of the things that's always been of interest to me with NZFunds is style. Just touch on that is the downside mitigation risks that you put in play for such an event like we're experiencing now. Are you able to elaborate that? I know some of this is a bit of financial jargon, so perhaps we could just sort of explain what downside mitigation actually is and the role that you play in making sure clients' portfolios are protected in a down market.
Sure. So we think about these scenarios. When I said we were, well prepared for it, we sort of break it up into 3 phases. Phase 1 is something that we always have invested within our portfolios, and that's our downside mitigation manager. Their name is Universa. So what is a downside mitigation manager? It's essentially like buying insurance. You have to pay away a premium every month, and that is not a very nice thing to do when markets are booming. So, throughout last year when markets were up strongly and there's a drag of, say, 1% or so on your portfolio because of this downside mitigation manager who's not making you any money. In fact, they're losing money each month as they burn through the premiums that you pay them. But we, as a philosophy, NZ Funds always will have some sort of downside mitigation manager within a portfolio as kind of like an insurance. Now, it is not to mitigate the entire downturn. In order to mitigate an entire market downturn would be a premium so high there'd be no point even investing. What we try and do is, if the market's down for this mitigation manager, if the market's down, say, 20%, if we can mitigate 5% of that, so be down 15%, not 20, using this manager, that's a good outcome. And it sounds like it's not a good outcome, but if you do the math on compounding returns, when you're only down 15% when the market's down 20, but you're buying back into the market at a cheaper rate, the compounding return differences over the long term is very high. So that's phase one. That's always in our portfolios, and it's sort of it's almost like you sort of put it in the bottom drawer and sort of don't think about it until you need it, which is obviously right now. Phase two is, we at NZ Funds, our philosophy is we're an active manager. So you obviously may have heard of passive managers. The most common, most well-known one perhaps in New Zealand is Simplicity. So their investments are literally just a reflection of the market. Active management is more where you have more of a insight into what geographies, what sectors, what companies you want to be invested in. Now, when markets are going up, being a passive manager is actually, a sound strategy, because it's that all boats rise in a rising tide type of strategy. In a down market, especially when you're nearer the end of an economic cycle, if we think about the type of economic cycle we've had in New Zealand and the US have had it really since the financial crisis of 2009, we've had fantastic GDP or economic growth. And as you get closer and closer to the end of that cycle, there are going to be companies and sectors and geographies you just don't want to own. For economic reasons or disruption reasons. I'll give you a really good example, Sky TV. With over the decade, as Netflix has got more ingrained into society, Sky TV is a company that you probably don't want as part of your portfolio, and as an active manager, that's something that we divested from some time ago. But active management also helps in being able to react to situations like we're in now. And with coronavirus, what we found interesting is using the number of contacts that we have globally, especially in the US, but also Europe. So one of the people that we've been talking to is the head of infectious disease at Imperial College in London, who actually came out and published a study for the UK government. Their view was that the spread of coronavirus was going to be unprecedented. And this was verified by a number of different sources that we had, as well as very well-known publications like The Economist, which provides incredibly insightful and very simple overview of what might happen. And it really did come down to the fact that if there's no containment or isolation, which we're in now, 70% of the population might get it. And of that, 15% could potentially have to be hospitalized, and 5% will be in intensive care. Now, those numbers, that still means that the fatality rate is very, very low. But just the overwhelming effect on the healthcare system, on the economy of people away sick, like my brother, who's, even if he could work, if he was allowed to in New York, which they're not, he wouldn't be able to because he's just got a really bad flu. That's going to have a major effect on economic growth. And we just weren't seeing that reaction in the economy and in financial markets. And so we took the steps to take a significant amount of risk out of our growth portfolios. And so how do you do that? You essentially just sell your growth assets. Now, that gets incredibly hard on terms of liquidity, but there are tools and things that we can use at NZFunds to enable us to do that very fast. But we could have got it wrong. And if you get it wrong and markets go up strongly and you don't have the investment that you used to in markets, that's also bad for performance, but the other way. And so essentially we have what was called almost like a collar strategy. If markets decrease significantly, we will mitigate a lot of that downside, half the downside. If markets increase substantially, we will eventually participate in that upside by having options that will help us participate on the upside. And so what we're trying to do is contain the losses, but also participate in the upside should that happen. And so that's what we've done in phase 2. So in phase 2, as of the 19th of March, and excuse the dates in terms of, it takes a while for pricing to come through, but we were down around, this is our, our typical growth client, so say a 45-year-old client, we were down around 14% when the market was down around 25%. And that difference really comes from those 2 phases, from our downside mitigation manager and also some of the things that we've been able to achieve being an active manager. And while down 14 is still down a lot, to mitigate 10% of that downside is to us an incredibly good achievement given how fast it's been, the fastest bear market ever. And that just, what does that mean? Well, a bear market is when the market's down 20% from its highs. And what does the fastest bear market mean? It just means it was the fastest time to go down 20% from your highs, which was incredibly quickly. And I think why were we able to achieve what we have? Well, it's a lot to do with the way that we operate in terms of always being conscious of the downside. I think that's just in our blood at NZFunds. But it's also our network of advisors and support that we have globally, which is able to give us a bit more of an insight into what's going on. So now we are in phase 3, and phase 3 is something that I guess a lot of people wouldn't be considering at the moment. But if I go back to what we talked about at the start, the $2 trillion stimulus package in the US, the stimulus package that Jacinda Ardern and Grant Robertson announced, which is also unprecedented from a New Zealand standpoint in terms of the support that they're providing. I was on the call just previous to this. I'm on the board of Hospice, and a charity has a lot of clinical workers, which are obviously still going to be working and get paid and supported, but a lot of the funding that Hospice gets is through their retail shops, which is obviously closed. And how do we make that, those are an important part of keeping Hospice running. A lot of our staff at Hospice will be able to continue to be paid given the government support, and we can redeploy those staff and help with other aspects of the organisation to keep it running. And that's a huge benefit for a charity. And so it's very easy to get overly negative about markets when governments are doing such intervention. We need to start turning our ear to, is this an opportunity to redeploy our capital that we took out of the market into fantastic companies, both fantastic New Zealand companies and global companies, at levels and valuations that are far lower than they have been. And yes, we'll continue to go through volatility, but if we think about the long term, actually are really good companies that we're happy to own now. Now, often we think about 10 years being long term, but let's be realistic. Let's talk about 5 years. We're buying companies that in 5 years could potentially be worth 40% higher than they are now. Now, you just have to be able to manage the volatility of that going forward, because it will remain. And that probably goes back to where asset allocation is, after all these things, after all the things that NZFunds investments team can do, it really goes back to your asset allocation. If you've got the right asset allocation and you can stay the course, and we are buying into companies that are a whole lot cheaper and have mitigated some of that downside, and you can therefore hold the line, you will benefit greatly on the upside. To at least get back to, the first point is get back to where we were before, and then on top of that, and then move forward through that. And if you think about the stimulus packages that they've announced, there's a good chance that over the next, say, 2-3 years, we could rocket back past where we were before. Given interest rates are zero, there's not really anywhere else to get a return, and the demand for share market returns will be greater. And so that's what we constantly have to think about. The mistake that everybody made, including ourselves in the GFC and the global financial crisis, is we did really well mitigating the downside, but we're far too slow in realizing the extent of the government support and getting back in and carrying on. Because we were worried about clients' experiences, but now NZFunds approach, along with people like Robbie, who we think clients are in the right type of setup, which means their volatility personally will be manageable. It means you can go back in earlier than perhaps those clients or those people out there that don't have a financial advisor, perhaps have too much growth assets and can't stay the course and end up getting nervous, taking all their money out, locking in the impairment of their capital, putting under the mattress, and that's probably the biggest learning we had from the global financial crisis, and one that we're certainly not going to repeat this time round.
Thank you, James. We've got about 10 minutes before the call ends. Just
like
to mention. Say again?
Oh, no, you go. Sorry, Robbie, I interrupted you.
I was just going to say that there is a chat box in the Zoom call, so if anyone does have any questions, feel free just to fire those through on the chat box while we're talking, and we can ask those, then everyone can benefit from that. One of the questions I've got is, it's interesting, James, about the stimulus package that the government's seeing as we're talking about that. What do you think is the appetite for further stimulus packages? Should this last 6 months and be a lot more significant than we thought initially? Does the government, New Zealand, US, Australia, do we have the resources to continue to keep putting extra money into the economy, and what would be the effect on the markets by doing that?
Well, I think on a New Zealand basis, and the good thing is you can be completely apolitical in this and say that Michael Cullen, Bill English, and now Grant Robertson have done an outstanding job of that continuity in keeping our books in order. We're really in an amazing situation, really, in New Zealand, where we touch government surplus, and our government debt is incredibly low compared to most other developed countries. We've got a lot more firepower that we can use, and I would suggest that if the lockdown that we're in goes from 1 month to longer, and especially around certain sectors who are hurting, I'd suggest that there's a lot more to come. I noticed that they've opened up the business $150,000 of claims for their workers to being unlimited and uncapped, and you've seen that in the UK with their job retention scheme as well. My mum lives in the UK. She owns a restaurant. She can pay her workers 80% of their salaries for the foreseeable future. I mean, that's quite amazing. The difference between UK and the New Zealand, though, is our books, our balance sheet in New Zealand looks a lot stronger, and so we've got the ability to continue to have that and not suffer too much once all this is over, being encumbered with huge amounts of debt. So I think the decision by politicians on both sides of the floor to not implement big tax cuts when it would have been perhaps possible to do is the reason why we're having now, and I think that's been a really good thing. In the US, I can be a little bit more perhaps I don't know what quite the word is. It's an election year in the US, and Donald Trump is fighting for his presidency. And so I think the $2 trillion, we could see a lot more than that. America, despite China's power in terms of economic power, the US is still the strongest country in the world economically. And they will absolutely do everything they can to make sure that the economy is propped up. And Trump's incentive to do it is even greater because he wants to be re-elected. Now, it's not all about Trump. They've got their political system with Congress and the Senate. But I think that most politicians know that they need to enact support, and I think if you see things not getting through the houses in the US the first time, they probably do the second time, and I think that's what we're seeing at the moment. So that was a really long answer to your question, Robbie, but basically saying that yes, I think if need be, we could see a lot more firepower from economies. How much firepower some of them have left, in the sense of what does that mean after this all, after we get through the initial difficulties, is going to be an interesting question.
We've got about 5 minutes. Thank you, James. I know that we're quite US centric, and there's good reasons for that, but there's obviously other economies happening out there, Europe itself, and there's Brexit. And Australia has been very quiet. It's always been a strong economy, certainly helped New Zealand through the global financial crisis, their financial backing and support. And some thoughts, comments about markets outside the US and New Zealand. Obviously, with New Zealand, there's good buying opportunities with companies that we're all familiar with. And I know that you guys spend quite a bit of time over in those markets on the ground with the various fund managers that you work with, which perhaps some of our clients aren't aware of, and just interested in your thoughts on what you've been able to learn from other providers outside the US market.
Sure. I mean, that's a good point, Robbie. We do spend a lot of time traveling as part of our making sure that we are across many markets. So London, New York, we were in Hong Kong in January, which was an incredibly interesting week. For the first 3 days that we were there, situation absolutely normal. For those of you who've been to Hong Kong, it's an amazing city, really busy and bustly. For the fourth day, lots of people were wearing masks. By the Friday, we flew out on the Sunday, so I had the weekend there, and on the Sunday, the streets were empty. That was sort of near the end of January. Very fast turnaround in terms of their reaction to the virus, and this is why you're seeing incredibly amazing bounce backs in sort of, or reduction in spread rates and bounce back in their just way of life in some of those Asian countries, especially China and Hong Kong, because they know how to react to these sorts of things. And that brings me to China. Amazing stock market performance within China. Most of that is because the government is basically propping it up and buying a huge amount of equities, and are determined to stimulate as much as they can. But we do own a proportion of our growth assets in emerging markets, and as well as Europe. Now, Europe's can be seen as a bit of a basket case, but at the same time, valuations in Europe were a lot lower, and so there was less of a euphoric valuation to those share markets. And there's just general opportunities within some of these markets as they improve over from what was a real terrible time during the European banking crisis and those sorts of things. Those European countries are slowly getting better. Now, this effects now will have a big effect of them, but again, there's stimulus from the ECB, the European Central Bank, which will help them, and so we are also invested in European markets as well. The other thing that we think about when we're investing is making sure we're exposed to our active managers, and that's what you mentioned before, Robbie. We have 5 active managers, which means managers that are investing some of your money in different jurisdictions, and we're in constant contact with them around how they are seeing the world, how they're investing, how they're tracking, and we're really pleased in terms of how they are performing. Some of them will track the market because they're more market orientated. So while they will ebb and flow with the market, they're still doing as we expected, and so that's a really pleasing thing. And also we can get perspectives from different jurisdictions, and it's fair to say our ability to mitigate the downside has definitely been helped by the fact that we've got all these contacts globally that I can pick up the phone. I've got a call with one of them after this and talk about what they're seeing and how they're reading things like the US stimulus package and those sorts of things. Because a good example, I can tell you everything you want to know about Meridian Energy. I can tell you that if it doesn't rain in the South Island, but it does in the North Island, you probably sell Meridian Energy and buy Mercury Energy, because I'm on the ground here in New Zealand. And that's the same with our managers globally. You know, they've got that, I guess, country knowledge that you just can't have without being situated there. I'm just reading the questions. Being able to access their funds. Look, I would say that's a really interesting question, insofar as that's not the first time I've heard it. And look, I think, Robbie, you'll have a view too. What I would say, though, is there's already the ability to access it due to hardship. And my view is that the criteria to access it won't change. However, you're going to see a lot more people that meet the criteria. And so while the rules may not change, I think the number of people that will potentially meet the criteria to be able to access it will increase. And so there is that ability. The guidelines are very strict around being able to do it. But I think that I would say that common sense usually prevails in these sorts of situations. But Robbie, that's probably one for you as well.
Absolutely. And we'd love to see people stay the course, because you're 70 before you know it, and your ability to earn an income from 70 onwards is what we're really aiming for here, so that we set you up with assets that fund your income and lifestyle. So at all costs, hang on to the money that you've got in there. We think that now's a great buying opportunity. There's good priced stocks out there, as James has told us. So if we can keep the contributions or even increase them and take advantage of a downside, pension upside in 5 or 10 years' time. We're just about out of time, and so I'd just like to thank you, James, for your time and input to the call. It's always appreciated. I get to meet you and see you, but most of our clients don't, and so it's really privilege to have your time here to do this. And hopefully we can do some more. Thank you all for your support. Stick with us. I'll be here. I'm working right through, and on the phone and email if you need to call or talk about anything at all. Thanks again, James. All the best to your brother over in the States and your family. Stay well.
Thanks, Robbie, and stay safe, everybody. And look, there's not much more I can do other than sit at my desk at home. So please do feel free to pass any questions over to Robbie, and I'll absolutely do my best to answer them. And if you still can't get the answer that you're looking for and you want to get on the phone, I'm more than happy to have a chat. So Robbie, I'm sure you can facilitate that. But yeah, there's if anything, it helps reflect when you're sort of talking through individual questions. So more than happy to take them. And thanks everyone, and enjoyed the time with your family.
Thank you, James.